Fed has nothing to lose with 50 basis point cut. Thank you.
Eased by a quarter point, but that they have nothing to lose by front-loading cuts and going big with a half-point cut tomorrow. Joining us is Stephanie Roth. She's chief economist at Wolfe Research. So, Stephanie, it sounds like this is sort of I think they'll only do 25, but that they should do 50 kind of thing?
Yeah, I think that's fair. They don't have anything to lose, like you just mentioned. We have rates sitting well above neutral. Neutral is close to 3% in our view. So they have a lot of time to be able to cut rates. So if they go 25 or 50, probably doesn't matter, because the important thing here is they're starting off the cutting cycle, which we all know they should be able to do. And the economy is starting to weaken, and they don't have to worry about the inflation side of it.
No. Wrong. Listen, if they start out with a 25 cut, okay, and then let's say in November they go 50 at that point in time, right? Because they see more, damage in the economy and inflation continues to come down. Then it starts to look like, ooh, what are you starting to see? You seeing problems out there? Or let's say they go 25, and then they bump it up to 50. Now all of a sudden it's starting to give the image that, oh, you're behind. So now you were doing 25s, but now you're doing 50s, right? They have all the positioning they could ever imagine right now to go 50 right now. Go ahead, do it. You're in the position. You're behind. Everybody knows you're behind. I don't say everybody. Anybody that knows how to read the data knows the Fed is behind. The Fed should have already started to lower back in around March, technically. So everybody knows they're behind. Go 50. You don't want to end up in a panic mode where next thing you know, let's say they start out 25. Oh, we don't want to do too much. Then all of a sudden they bump it up to 50. Then they bump it up to 75. The market's going to flip. The market's going to be like, hard landing, it's coming, we're donezo. It's at the end, right? You can't end up in that situation. Start out 50. Do another 50. And then if you want to bring it down to 25, then it looks like, oh, okay, everything's really good. Then you can make that decision at that time. But the last thing you want to do is start out too slow, and then next thing you know, you're doing 50s. Next thing you know, you're doing 75s, like they had to do in the rate, because that's what freaked the market out so much in 2022. Is all of a sudden they started out 25s, little baby rate hikes. Next thing you know, it was 50. Then it was 75. And that's when the market was freaking out in 2022. And that's when you saw all those tech stocks falling 40, 50, 60, 70, 80% in less than a year. From where those stocks were priced in the fourth quarter of 2021 to where those stocks were priced in the fourth quarter of 2022, you saw some of the best tech companies in the world fall 30, 40, 50, 60, 70, some even 80% peak to trough. Historic losses. That's what happens if you're really going to freak things out. And that's what happens when you have to all of a sudden go from small moves to big. Then people start to flip out. And the difference with this one is it won't just be the market will flip out. We'll get an actual legit big recession if that ends up happening.
Now it's all about the employment side. And whether they do 25 or 50, at least they're getting started.
But you got to keep in mind the consumer is in a lot weaker place now than they were when we went into the rate hike cycle. And so now if you're talking about some sort of a situation where let's say the Fed freaks the market out, you start getting stocks to crash, next thing you know, you start getting companies to do major layoffs. I'm telling you, the consumer's not set up to weather that storm like they were in the 2022 storm, which would end up meaning essentially big problems for the actual underlying economy.
This is that, they do the 25, but it's a really, really tough call at this point.
Steve, I think they should go 33. And get rid of the range, and they go to 5 on the no more range. They just say we're cutting to 5%, and you're welcome.
Why 33 though, and not like why 33? Why not 37.5? I'm a little confused.
Well, with a person with as many kids as you have at home, the idea that you're looking for compromise and to make everybody happy does not surprise me.
If only it worked like that.
I also did that as the middle child in my family, looking for compromise. But in any event, I think the key is going to be 25 with a forecast for more to come. It'll be interesting to see if they forecast a full 100 for this year. That would be something of a salve to the market if they only get a 25, and what they forecast for next year. So those dots are going to be an important part of the communication, as will the statement. We'll see how aggressive the Fed.
The dots will be important for the market to look at, but just be honest, the Fed has no conception or clue where they're going to be moving rates 6 months from now, 12 months from now, 18 months from now. That is something we know factually.
ends up forecasting in the statement, which I like to follow very carefully because as much as anything, that's a reflection of what the full committee can get behind. And speaking of the full committee, there's an issue. I'm interested in our guest view on this, whether or not the chair would have unanimous support on a 50.
Stephanie, what do you think?
Yeah, I think it's very possible we'll see, a dissent or two if they go for the 50. And that's the thing, is it seems like Powell is supportive of the 50. Perhaps that's some of the news stories that we've seen over the past week or so is kind of reflecting the leadership's view. So it seems Powell's probably in support of the 50, but is he going to get support of enough folks that they can actually go through with the 50? Which is why we ultimately are calling for the 25, just because it's going to be difficult to get enough of a quorum. So base case is that they'll go with the 25 and they'll get everybody on board. If they go with the 50, it's possible they'll have some dissents along the line.
Quickly, I want to bring Rick in a second, Stephanie, but were you struck as I was, or am I missing something, that the retail sales report comes out, not only is it, we can talk about the consensus, but we all know the whisper was that it was going to be really weak. I've heard people talking for 3 weeks about how they were concerned that this retail sales number was going to be weak. The headline, I think, was up 1/10 from July, which was decent. The core was up 3/10. So as I understand it, the GDP sort of data puts GDP, like Steve was saying earlier, 2.6% annualized for the third quarter. I think to myself, well, clearly this is going to make the case for 25. I go and I ask my team for the market odds, Steve's team, and they've risen to 65% for a 50. What am I missing?
Yeah, I mean, so what we've seen over the past number of months is that the credit card data, which a lot of people use to help forecast what's going to happen in terms of retail sales, has been understating the print. Perhaps some of it has to do with immigration, and folks who are not on traditional credit cards are are spending, and that's lifting the print to some extent. But we've seen the credit card data underestimate what's going to happen. So we got a decent consumer spending number, which has been the case for much of this year. Consumer spending has been tracking well above trend. The market is just looking for this 50 basis point cut. Whether or not we get it, maybe it doesn't matter so much, because if they do a 25, they're going to do it dovishly. If they do a 50, they'll do it hawkishly. So perhaps there's just too much emphasis on this debate between 25 and 50. But what we're seeing is a consumer that's kind of holding in okay. And our base case is the labor market is actually okay too. So realistically, what a soft landing looks like. And it's going to be up to whether the 12 people in the room who are voting are going to be in support of this 25 versus 50.
Yeah, that's an interesting wrinkle.
So yeah, either way the Fed cuts tomorrow. Let's say they go 25. Well, each side's going to have an argument, right? If they go 25, you know what the bulls are going to say? The bulls are going to say, hey, bottom line is we started a cut cycle. That's good for the markets, right? That's what they're going to say. Bulls are also going to say, hey, they only did 25 because they know the economy is so incredibly strong, right? And so we're getting a cut cycle into a very strong economy. Boom, we're booming, baby, right? Now, if they do 50, right, then the bears are going to say, oh, they did a 50. Well, yeah, that's a big rate cut for you guys on the bullish side, right? But they're doing that because they're really fearful of what's going to happen with the economy. And they feel like they have to cut 50. And so that's bad news, right? So whichever way the cut happens tomorrow, whether it's 25 or whether it's 50, the bulls and the bears are going to ultimately have arguments to be made whichever way they go. And that makes it tough to really get a decisive way in which the market's going to move really tomorrow. And so a lot of people are expecting either a massive drop or a massive... I wouldn't trust either move. If the market dropped a ton tomorrow or if the market went up a ton, I wouldn't trust either move, to be honest. And the reason being is there's going to be such a strong argument made on the other side that all of a sudden the market could flip the other way easily.
The retail sales as it relates to immigration, I hadn't heard that. Obviously, there's a lot of areas we're looking at to see if there's either seasonal distortions because of immigration unauthorized or so forth. And it's just a sort of data point I think we need more clarity on. Steve, what were you going to say?
I was going to say that there's fast money and there's slow money. Fast money cares a lot about the 25 versus 50, and they're going to come in tomorrow and express their pleasure or displeasure. I think from a long-term investor point of view, follow the guidance, figure out where the Fed is going, and let's listen to the answers from the chair about why they're going there and how far they have to go. Those are the things I think that are going to be ultimately determining bond and stock prices over time, apart from the gyrations you're going to get at 200001 when that statement comes out tomorrow.
Yeah, and then the presser, we'll see how that changes things as well. It's going to be an interesting afternoon.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That is my personal advanced software that I use to make my investment decisions when I go to invest in companies. As somebody that's been in the market 15 years, I got sick and tired of using these different services that folks have out there that are designed for traders in the market. People that are looking to get in and out of stocks. That's not what I'm here to do. I'm here to long-term invest. I need to be able to see all the different ratios and metrics that are very important for me as a long-term investor to judge if I'm getting a great deal on a stock or if I'm getting ripped off on a stock. I need to be able to compare different companies versus each other and be able to do that in a matter of seconds rather than it taking hours like it used to before I created this service. I want the ability to listen to conference calls, see SEC filings all in one service. That is what we've created with 1000xstocks.com. If you are looking to access this software, go down to the description area of this video. You can click the link down there and apply for access. If you don't want to do that and you want to search a website, go to 1000xstocks.com. Enjoy it. Now, there's one thing that will be felt really rapidly here, and it's not a good thing for us that have money in savings accounts, is I'd almost guarantee you there's going to be cuts coming in all savings account rates over the next 30 to 45 days. So if you have money in a high yield savings account, whether it's through an Ally or whether it's through, I don't know, Marcus product at Goldman Sachs or any of the other ones, some of the regional banks, whatever, right? If you have money in a savings account and it's getting you 4 to 5% right now, which is where a lot of the higher yield online savings accounts have been getting you, you're almost guaranteed to see cuts in that amount of money over the next 30 to 45 days. You're likely going to receive an email to your inbox and it's going to say, "Hello, Johnny, we're lowering our rates to this." And don't be surprised if a few weeks after that you get another email that says, "Hello, Johnny. Hello, Samantha. We're lowering the yields again." Okay, so that's a little food for thought in regards to that. They're going to say they're going to be competitive, but once they all start lowering, they just one after another, after another, after another, because they can all get away with it, right? So now in regards to, are you going to get some, if you have credit card debt, which I hope most of you guys don't have any sort of major credit card debt, right? If you do have that, don't be surprised if you still have to pay really high rates in the short term. Unfortunately, it is what it is, right? The good side, they take that down right away, but the bad side, that takes a while. No different than when gas prices, if oil price shoots higher, gas stations are quick to move that price up. But then all of a sudden gas, a barrel of gasoline goes down, oil goes down considerably, and gas stations are really slow with moving those prices back down. I come from the gas station industry. I know what that's about, right? And so that's what happens in regards to this. Credit card rates, you're still going to be paying big numbers on those, but don't be surprised if your savings account rate drops a lot over this next 30, 45 days, which then you start saying, okay, what are people going to do? A lot of people have a lot of money in savings accounts. If their rates are going to go down, it's not like it's just going to go down for the next 30 to 45 days. If the Fed keeps lowering Fed funds rate, which they likely are for the next 1 to 2 years, it's going to keep going down. So then what do? So then you start to say, okay, I need yield. All of a sudden these savings accounts are starting to get 2%, 3%, right? So then you're going to look to treasuries. Well, here's the issue. Treasuries are starting to yield less and less and less. All these guys were yielding 5% not that long ago, like literally just 6-9 months ago. All these guys were 5% plus, 3 months, 6 month, 12 month, 2 year, 5 year, right? It was phenomenal. And they're going down and down and down and down and down. The 3 month now is down to 4.76. 6 months down to 4.5. The 12 months down to under 4. The 2 years down to 3.6. The 5 years down to 3.4. And keep in mind, these will likely continue to go lower for the next 1 to 2 years. So you're suddenly going to be in a situation where people's savings account rates are going to get cut significantly over this next 12 to 24 months. And if you've been making money in treasuries, that substantial amount of money is going bye-bye as well, which is not going to be fun for people, because then people are like, what do I do? Where do I go? I need yield. I got money, I need yield. And I can't get in treasuries, I can't get in savings accounts. So you know what they're going to do? They're going to start going back into the good old dividend stocks. Dividend stocks have seen a massive sellout in regards to value in dividend stocks for really, it's been over 2 years. And the reason was the Fed raised interest rates so much. Next thing you know, you can start getting 4% on treasuries, 5% on treasury, 5.5. I remember it wasn't that long ago, it was probably in the past year, you were able to get over 5.5% on a treasury, right? And so people were like, why would I own dividend stocks when I could get 5.5% guaranteed from the government and treasuries, numbers that we haven't seen in decades? Why would I do that? So people said, the hell with these dividend stocks. And they sold out, and it put the most selling pressure you've really seen on these value and dividend stocks. It put the most pressure on them we've honestly seen since the great financial crisis. I mean, historic drops. And many of these value and dividend stocks are trading at 4-year lows, 5-year lows, 7-year lows, 10-year lows, some at multi-decade lows right now. Because it was just a complete sellout of these stocks because people are like, I'm going to get 5% at the bank. I get 5% at Ally. I get 5% in treasuries. I don't need you dividend stocks. But what we're going to see play out now, 2025 and 2026, a big move back into where? The dividend stocks. These same people that sold these stocks heavily in 2022, 2023, and into this year are going to come back like nobody's business in 25 and 26 and say, oh, dividend stocks, I missed you. Because now we're not getting what we used to get over there in those savings accounts or treasuries. And the more the Fed moves rates down, the more the dividend stocks are going to become the play. And especially as a lot of these dividend stocks are still recovering from kind of the Rona cuts of dividends and those sorts of things. A lot of them still have a lot of room to raise their dividends. So what you're going to see now that these stock prices have fallen so much and they're going to likely raise dividends is they're going to command a bigger and bigger yield. So dividend stocks are yielding more and more. Meanwhile, guess what? These are yielding less and less, savings accounts and treasuries. So you're going to have a bigger and bigger move, and that's going to be a multi-year move. That's a 2-year move. So it's not like it's just like people are going to buy dividend stocks one day or 1 week. No, this is going to be for the next 2 years. The next 2 years, people are going to be moving money out of treasuries, moving money out of savings accounts, and they're going to be moving money into dividend stocks, and it's going to be a 2-year move. No different than it was a 2-year plus move in terms of the exodus of these dividend stocks and people leaving these, right? So a little food for thought in regards to that. No, if you look at what I'm buying, I do a lot of videos on the channel. Like, you look at my buy watch list, look at this video, I spent $32,000 on the stocks, 6 stocks I just bought, $45,000. What am I buying, right? I'm buying dividend stocks. I'm beating Wall Street to the punch. That's what I'm doing, right? I always kind of got to think about, like, how do I beat them to the next opportunity before they see it? So in 2022, for instance, that was tech stocks. So I beat Wall Street to that, right? I was buying Meta, I was buying Palantir, and I even bought Netflix for a while. I never thought I would own Netflix, even bought that. That went down to like 170 or 185 or something like that, right? Shopify, buying all those sorts of stocks. I beat Wall Street to the punch there. And then what happened? 2023 came along, and next thing you know, Wall Street wants to own tech stocks again, right? And they start buying those stocks up left and right. And then that continued through, obviously, into this year, 2024. So you got to beat Wall Street to the punch. I knew they were going to come back to those tech stocks. They love those tech stocks. Are you kidding me? They're addicted to those tech stocks. They're addicted to owning NVIDIA and Meta. You think they don't want to own those? No, there was just a short-term sellout, and then they came flooding right back to those babies, right? You know what Wall Street also loves to own? And there's a huge segment of those investors. They love to own dividend stocks. They're going to come back in droves over this next couple of years to those stocks. And it's going to be more and more and more. And you're going to go from those stocks having just immense selling pressure on them for 2 to 3 years to immense buying pressure on them for 2 to 3 years. And keep in mind, when it comes to these stocks, it's not like investors are going to be looking to get out anytime soon. Because you got to keep in mind who's buying value and dividend stocks. They're usually much longer term in nature investors. The only way you really get those folks out of those sorts of stocks is what? Take away, go have 5% plus from the government guaranteed, and people will leave those stocks. But you start to take that away, and those investors stay with those stocks for years or sometimes even decades to go in the future. They're not looking to move the money out because they're like, I'm getting my 3%, 4% yield from that stock plus share price appreciation. Why would I move out of that stock, right? So that's just a little food for thought in regards to that. And we know in terms of dividend money, that's taxed as long-term capital gains, which is a very low tax rate. So people love to own those sorts of stocks. So you're going to see a lot of buying pressure for multi-years coming into dividend stocks, right? And you see it. Like, Wynn Resorts is a perfect example. Wynn Resorts is a stock that's down 26% in the past 5 years. Is their business been doing bad in the past 5 years? Absolutely not. Obviously, it got devastated in Rona because they were forced to close their properties. But outside of that, look at their numbers. They're pretty much the best they've ever been. They're incredible, right? And so now we're going into a low rate environment. And this is going to help Wynn in multiple ways, right? One is now any debt they have, they're going to be able to pay, they're going to have much lower interest expense. It's going to help their profitability in a major way, right? And plus, people are going to be in the search for yield, and they're going to look to a stock like Wynn, who's likely going to keep up in their dividend over the next few years, and they're going to say, you know what, I need to get into a company like this. And so you'll see a multi-year move into a stock like Wynn, when really it had a multi-year sellout that was absolutely brutal for that stock to go through. A stock like Estee Lauder, All the debt on that company going to be in a much better place as yields go down and down and down, right? Less interest expense. Meanwhile, guess what? People are going to look at a stock like Estee and they're going to say, ooh, that's a nice dividend yield on that, and I can probably get good share price appreciation. And you'll see a move into the stock in 2025, 2026, right? Multi-year move, and next thing you know, don't be surprised if that stock's also in 150, 200 plus a share. Nike, same exact situation. Nike down almost 4% in the past 5 years. People said, oh, hey, I get this great yield from treasuries. Why would I want to own Nike, right? If I can get 5% plus on treasuries, there's no point in owning Nike. So they moved out of that stock, and it was what it was, right? But now you're going to see a multi-year move into Nike stock. Cheesecake Factory, same exact thing. Yields around 3%. Don't be surprised that dividend goes up in future years. Stock hasn't gone anywhere for 5 years because people say, why would I want to own Cheesecake Factory stock if I can get 5% plus on treasuries, right? And you can see every single one of these stocks, right? Just relentless selling pressure, and now you're going to see relentless buying pressure on these stocks for years to come. Meanwhile, if people wanted to sell these stocks, by this point in time, they've already sold, man. I'm just going to be honest with you guys. If people want to sell Wynn and Estee and Nike and Cheesecake Factory, they already sold for the last several years, right? And so it's no different than I talk about PayPal a lot, right? PayPal, people sold that stock heavily for how many years in a row? Like 3 years plus in a row, people sold relentlessly. PayPal, sell, right? And eventually you just run out of sellers. And people are just like, there's no one left really over there to sell in any substantial way. Meanwhile, as the story gets better for a company like a PayPal, you get more and more buying pressure to come in, right? And that's how you get that share price to go up and up and up. Lack of sellers, more buyers, right? More buying pressure, boop, 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 and the share price goes up and up and up. It works in the inverse when things are going bad, and that's what's happened in these stocks for the last several years. So that's a little food for thought in regards to that. Now, as far as some hedges I'm looking at out there, I'm actually really interested in Toll Brothers. Now, here's the thing. Okay, almost all these home builders are at all-time highs right now. And the reason being is the Federal Reserve's cutting rates. So there's this assumption, right, that because the Fed's cutting rates, mortgage rates are going to go down a bunch, and there's going to be this huge pent-up home buyer demand, and it's going to bode extremely well for all these home builders, right? And that's the assumption. But as we know in the market, many times things work the inverse way people think it should work practically, right? These home builders have had the most, I would say that the best advantages you could ever imagine. Inventory was insanely low for the last several years in regards to the housing market. And that was phenomenal for all these home builders, right? Additionally, they did all these 1 year, 2 year incentives where you had a much lower interest rate if you signed a contract and those sorts of things. That helped those home builders out a lot, right? Both those advantages are slowly starting to go away. And what I'm starting to see in regards to somebody like a Toll Brothers, remember, Toll Brothers is really focused on their average selling price is like over $1 million. So that's where they're really focused, right? And I'm personally seeing $1 million plus inventory pile up now at this point in time. Like the amount of inventory that's just come on the market in the last, I would say 30 to 60 days, I'm seeing a lot. Okay, seeing a lot of inventory pile up on that $1 million plus bracket, which is not good news for Toll Brothers. In my community, I live in here in Vegas, right? The homes are priced between about 2.5 million and 3.5 million. As of right now, we're sitting at an all-time high amount of homes on the market in my community, right? That's not something I look at and say, oh man, that's great news for Toll Brothers. That's something I look at and I say, that's competition for Toll Brothers. No, people have all these different homes to pick from in my community, or they could pick from that other community. And keep in mind, if there's an all-time high in regards to homes, guess what? It's, people that are selling the homes aren't that dumb. They're going to eventually look out and they're going to say, oh man, I got to get competitive. And so if you do get somebody that's trying to buy your home, they could throw a lowball offer, and you might have to actually consider that lowball offer. You might not get another offer for 3 months, 6 months, 12 months, 18 months down the road, right? And so this is not a good thing for Toll Brothers. And at the end of the day, I'm looking and I'm saying prices must come down. The inventory is hitting too high on a lot of these homes. I was even looking at, last night I was messing around looking at even like Newport Coast. Newport Coast, one of the richest areas literally in the world. Like Newport Coast, insanely rich. Cheap home in Newport Coast, 5 million plus, okay? Cheap home in Newport Coast, still like 10 million. So I was looking at homes all the way 5 to 20 mil. Man, it's starting to pile up even in Newport Coast, which is one of the richest areas literally in the entire world. And I was looking and I was looking at how many homes have been on the market now, 6 months, a year, or more than a year, and I'm like, dang, it's a pretty long list, right? It doesn't bode well for somebody like Toll Brothers or for the high-end housing market. And so this is something I'm looking out there and I'm like, I don't know if it's going to be as great as a lot of people are assuming for these home builders. Everybody's on the assumption that this is like going to be boom times for the home builders for the next several years. And I'm looking and I'm like, I don't know. Like I'm seeing inventory pile up here, and that's not good. What happens if it keeps piling up for the next, few months? I don't think that's going to bode very well for Toll Brothers sales numbers come 2025. If next thing you know, you have prices going down and you have inventory piling up, all of a sudden Toll Brothers has real competition in the market again. That's not going to be good for them, right? That's going to be poor for their sales numbers in 2025, which then starts to hit your numbers in 2026 and 2027, because we know there's a lag time. Because Toll Brothers numbers have been pretty decent in regards to their sale numbers, right? For the past, I would say, year, they've been pretty decent. If that falls off next year, the revenue is still going to look great because those homes are going to be delivered next year, right? But then your numbers are going to be weak for 26, 27, which then you get a big sell out of the stock. The issue I have with Toll Brothers is the put options are so expensive on this stock. Incredibly expensive. Like I was looking at like 150 strikes. I got to pay $20 for those that are less than a year out. I'm like, so now I need 130 to break even. I need 110 to double up my money. I don't love the risk reward there, right? So I think there's some other folks out there that maybe on the DL are seeing things the way I'm seeing them, and they're bidding up those put options big time. So I'm like, $20 is a pretty substantial number, right? Wingstop, this is another one I'm looking at right now. This has been an incredibly hot stock, up 313% over the past 5 years, and a lot of that, honestly, has come really just in the past 2 years in regards to this stock. Wingstop, this is a difficult one for me because, one, I don't think Wingstop's very good quality. It's like very okay quality. I don't think Wingstop's like anything special. And their forward P is 121 in the stock. Their 2-year forward P is like 90. So they basically need, the way I would look at this, they basically need a 4x or 5x their revenue and earnings per share over the coming years to eventually make this valuation make sense, right? The price to sales ratios on this stock is just ridiculous. It's like 20 plus. It's laughable. But there's always a great saying in regards to hedging or shorting stocks. You can't just rely on valuation. Wingstop's valuation, silly. There's got to be something more to the story for Wingstop. Maybe growth rates are much slower. I got to find something else before I can make a hedge on Wingstop and bet against that stock to make me say, you know what? So I got to find something. There's got to be something I find on Wingstop. But if I can find another thing on Wingstop other than just a silly valuation, I'll probably buy some puts on this one, and I think that could be a great opportunity because I think there's a chance that the market cap could go down to like, $5 to $7 billion type range, right? Now, you need to load the boat on value and dividend stocks that are proven that they can get through a recession. So it's going to be very important in regards to value and dividend stocks you do buy, because I think there still is recession risk out there. A lot of people are debating, have we had the soft landing? I wouldn't say we've had the landing yet. We need to see how this next year, because now we're going into the cut cycle, right? What happens over this next year? If over the next year we don't have any sort of major recession, if unemployment rate stays under a 5 or a 5.5% number, I think we can call this a soft landing, right? But if all of a sudden, next thing you know, 6 months from now, 12 months from now, we see unemployment go to 5%, 6%, 7%, well, then we never had the soft landing. It wasn't landed, right? We had the hard landing after all. So there is still recession risk out there. So you want to, if you're buying these value and dividend stocks, you want to buy the ones that have proven they can get through a recession. The reason being is then you're going to feel comfortable holding those stocks, right? And maybe even buying more during the recession. They're like going to get through to the other side, right? Additionally, you get to receive all that dividend money while the recession's going on. Stocks are crashing, right? And we know tech stocks usually get hit the hardest, which means then you can use that dividend money to go ahead and buy tech stocks at that particular time, which would be absolutely beautiful, right? Now, if there's no recession, then you'll likely get sweet share gains, right? And you're likely going to receive a bunch of dividend money as well. And keep in mind, a lot of these dividend stocks are going to be upping their dividend quite a bit over the next couple of years, because basically their profitability is going to go up a lot because their interest expense is going to go down. Meanwhile, if their business is getting in a better and better place when it comes to profitability, that's going to be phenomenal, which means their dividend amount is going to increase. So you might buy a stock at a 2% yield today, right? Let's say 2.5%. You buy a dividend stock at a 2.5% dividend yield today. But let's say the company gets a lot more profitable over the next couple of years. they might up that dividend. And so on your shares, next thing you know, you might be commanding like a 3% yield on your shares, or 3.5% or 4%, right? There's always a famous, kind of look at Warren Buffett and his Coca-Cola position that he bought back in the 80s. And I believe on some of the Coca-Cola shares he bought back in the 1980s, I believe he's receiving over a 100% dividend each year from those Coca-Cola shares because of what he bought at, essentially, versus what the dividend payment, I believe the dividend payment today on a lot of those shares is more than the share price he paid for the entire shares of the company, which is insane. That means he's getting over 100% dividend yield, right? So that's something to kind of keep in mind there, and that's the way I would think about that, right? Tech is not the big opportunity now that we're going in this rate cut cycle, in my opinion. And when I say it's not the big opportunity, it doesn't mean there's not money to be made there. I think there's money to be made there. I think there's money to be made in Amazon, in Meta, in several of these other stocks, right? Shopify. But I don't look at it as the big opportunity. The big opportunity is in those value and dividend stocks because of how well those set up. And if we do go into the recession, those stocks just hold up much better than the tech stocks, right? So if we are in an upside market, I think those ones are going to see more upside than tech stocks. If we see a downside market, I think those ones are going to fall much less than, let's say, tech stocks. Tech always gets hit the hardest when you're in a recession, right? So the big opportunity right now is not in tech, right? When tech was in a big opportunity in 2022, and I do believe big tech in general could emerge as a big opportunity again in, let's say, 2026 or 2027, if a big recession hits, right? Let's say a recession hits, market goes down, S&P goes down 25, 30, 35%, 40%, whatever, 50%, okay? Some crazy market crash, right? 25 to 50%, let's call it. Then I think tech stocks would then emerge in 2026 or 2027 as the big buy at that particular time, because those stocks would be beaten down nasty style, right? But for now, I think there's money to be made there, but I just don't think that's the most money to be made there, right?